Okay, hello. Um, Welcome back. Thanks for joining us for tonight's webinar uh, on the market outlook for the second quarter of 2026. Okay, before I bring in the team, let me say thanks again for joining us, and to our Muslim viewers, selamat berbuka puasa. Okay, as usual, I'll be taking you through the our expectations of the market environment, the conditions. Okay, after which Pak Leng will be taking you through on the and updates on the sectors lah. And last and but not least, we'll have Crystal, okay, taking you through our stock recommendations now for the local Hong Kong and US market. Here they are, Pak Leng and Crystal.
Hello. Hi everyone, good evening.
Okay, without further ado, okay, let me take you through what we're expecting over the next few months. Hopefully, not all are bad news. Okay, right. Next, please. Okay, although not all are bad news, but I have to start with Trump. Okay, I think Trump, as I term it, remains as the master blaster. Okay, to global geopolitics as well as the financial markets, to say the least. I think his recent foray into Iran, I think certainly saw oil price spiking beyond the 100 USD per barrel, like what we saw, I think, today as well. All right. And finally, Wall Street is reacting, I think, came to the senses and reacting to the to all these, vagaries of the market, and we are seeing some selling on the three major indices lah. Okay. Of course, looking at the movement of the crude oil price, certainly inflation is going to rear its ugly face again in the US, especially. So over the short term, we do not expect any cut in the interest rates until when there's a change in the Federal Reserve chair in the middle of this year, and then we'll take it from there. Okay. All right. In the latest update locally, earnings growth for corporate Malaysia has been adjusted to, I think, flat. Okay, safe to say, rather than negative 0.2%, from a growth of 1.3% before. And this is due to the huge one-off item that's been written off by both PBB and also Petronas Chemical. All right, I think to the tune of a few billion ringgit. That is why we saw, we are seeing flat earnings growth for last year. Nonetheless, for this year, 2026, I think the earnings growth has been adjusted to 7.9% from 7.1% before. I think this is due to the lower base the previous year. And also for this time round, we are introducing earnings growth for 2027, now premised at 6.5%. All right. Next, please. Okay, move over to US. I think I have to show you this map that we have collated, right? What I term as Trump's roadmap to disaster. All right. I mean, if you look at what Trump has been doing during his, I think, more than a year in office, all right, since January last year, I think he's done numerous unexpected, things. Nonetheless, the Wall Street is not reacting negatively to it. I think this is rather mind-boggling. Okay, that Wall Street is still charting all-time high, record high, as you can see in the third quarter of last year. The Dow Jones Industrial Average charting record high until early this year. Okay, until when the U.S. Israel declared war on Iran, and then we are seeing Wall Street came to the senses, and hence some selling on the US equities. I think this is also exacerbated by the bad or weakening labor market. I think for February, there's no addition to the job market, coupled with a small hike in their unemployment to about 4.4% in for the latest 4.4% from 4.3% before. So all this has stimulated into some negative investment environment, all right, for traders to lock in some profits. I think the spike in crude oil price has been the main item that's negating the investment climate. All right, next please. Okay, after showing you Trump's roadmap to disaster, okay, I've been thinking, looking at the US headwinds and tailwinds, a comparison. Okay, I think headwinds for the US easy. As you can see from the left column, I can easily list a lot more. All right, but tailwinds, I've been sitting around and thinking, right, what has been popular in the market? It is only the AI boom. All right, so again, the tech sector has been how to say, supporting the Wall Street lah. But looking back at the left column, right, I mean, there's been a spectrum of headwinds lah. So hence I say, winds of change in the US, especially the national debt of USD 39 trillion and spiking up because of the war in Iran, which is costing about $1 billion a day, right? And then of course the volatile oil price lah. And the latest, right, has been the worries over the elevated level of private credit, currently trending at around 1.8 trillion USD. All right, these are the loans given out by non financial organization. All right, I mean like what they call shadow banking over in China lah. All right, I mean there are concerns that this may escalate into a potential black hole for the US financial system, with currently default rate at a high of 9%. All right. Having said that, right, looking at the last row, you can see that the record high household debt as well, currently at 19 trillion USD. All right. And also at a rather high default rate of 5%. I think with these two, I think we need to stay very vigilant on the US financial system. I mean, the banks and also the non-banks entities. I think the latest regarding the private credit, right? I think the biggest venture capital, I think BlackRock, they are facing with some cash flow problem. All right, they are limiting investors to possibly withdraw their investments to withdraw from their investments. Okay, so keep an eye on this US private credit segment. All right, next please. All right, this is the slide that I wanted to show you regarding the middle class in both China and the US. I think 20 to 30 years ago, I still remember, I think US middle class has been the main engine of growth for the US economy, right? I think you see that, back in 1990, not too bad. You see that the US GDP per capita is on the uptrend. You see the blue line. I think while China's GDP per capita is negligible, okay. But come 2005, all right, I think you can see the China's, uptrend in the GDP per capita has spiked up in a very steep, gradient to overshoot or overtake the US growth. Look at that. I mean, I think China's from 2005 GDP per capita of around USD 2,000 has escalated to more than 13,000 USD. Okay, a gain of more than 6-folds. All right, and for China, 40% of the population, right, has been termed middle class from less than 10% in 2005. All right. On the flip side, US GDP per capita 2005 45,000 USD. Okay, it improved to 85,000. It was only about 90% increment. All right, and in fact, their middle class actually declined. 51% of their population declined from 53% in 2005. You can see, the engine of growth, all right, is certainly shifting to China. I think with this burgeoning middle class, right, certainly if the Central Bank of China is doing something right, their engine of growth certainly would benefit from it, especially when funds are injecting to instill the domestic consumption. All right. Next, please. Okay, this is my favorite slide as well. You can see, the holders of US Treasury from 2015 to 2025. China's holding in the US bonds has, I think, dwindled by almost half, from almost 1.3 trillion to now about 680 billion USD. I think Japan remains as the top at the moment, and we can see, surprisingly, Cayman Islands has increased their holdings to 400 over billion from 200 over billion. Who are the investors? You tell me. I'm not sure. All right. So I mean, you can see that, so slowly but surely, like, definitely Asian countries are withholding their desire to hold any more US denominated assets, especially US bonds. I think with current developments within their political and financial system. All right. Next, please. All right. Moving over to Hong Kong. Okay. Despite the uncertainty in the Middle East, I think recently China has there are 2 sessions parliamentary meeting. I think their main priority is to improve domestic consumption. I think this will certainly stabilize confidence. All right. So I think during the 2 sessions, right, I think PBOC, okay, their central bank has also reiterated their desire and also there are more room for additional cuts in the RRR, or their reserve requirement ratio. Okay, and then to recap, right, for every 25 basis point cut, there will be additional USD 80 billion, all right, or almost a trillion renminbi pumped into the financial system. I think this could happen very soon, especially amid the heightening uncertainty from the Iranian war. All right. As for Hong Kong as well, I think corporate earnings growth is estimated at a decent 10% for this year. All right, due to the anti-involution policies, which will improve margins. All right. So I think this also underscore the reasonable valuations amongst the Hong Kong equities as against the US peers. All right, this is what I've came across. All right, the foreign fund managers are expecting there'll be more upside for the Hang Seng Index to around the 28 to 29,000 level by this year end. I think this shows that foreign fund managers are also very confident of the happenings or the developments within the Chinese and Hong Kong market. Next, please. Okay. Contrary to what's happening in the US, still hammered by high 10-year yield, high interest rates. As you can see that the China's 10-year yield has been trending between 1.6 to 1.9% over the last 1 year. So that's why you can see the vast improvement in the Shanghai Composite Index, as illustrated by the red color line here. I think 1.6 to 1.9% over the past 1 year, that is way below the US 10-year yield of between 4.2 to 4.5%. You see the discrepancy or not? So I think, if anything, the investment environment is certainly looking better in China and Hong Kong, or Asia for the matter. Right. Next, please. Okay, again, this is the 10, China's 10, Terror 10, or the T10, all the tech companies that we are monitoring, and some hasn't performed that well. Year-to-date performance, you can see that some of them are churning out double-digit decline. If I were you interested in tech companies, I think the top two would definitely be a certainty. Okay, Tencent and Alibaba. This would be the first to look at before you look at the rest. Next, please. Okay, talking about valuation, I think the Hang Seng Index, despite now currently trading slightly above their historical average, but based on those in Wall Street, right? For example, Dow Jones, Nasdaq, S&P 500, it is still way below their premium. I mean, you look at the Dow Jones, 24 times, as per about 16 times historical average. I think all the three major indices on Wall Street is trading at a huge premium to their historical average. I think with the diminishing premium within the global stock market, right? Certainly, we expect fund managers to look at value proposition to be their main attraction. Hence, Hong Kong would be the main destination for foreign funds. Next, please. All right. After US, Hong Kong, let's go back to Malaysia. I think after what happened over the last couple of days, I think year-to-date change in the index is only 1%. As for the currency, not too bad, up 3.3% against the USD. All right. I think I'm quite confident with the ringgit, all right, against the regional currency and also the US dollar as well. Next, please. All right. Fund flows so far, okay lah. I mean, there's no complaining. I mean, looking at the foreign fund net inflow of 1.28 billion year to date after a 22.3 billion net outflow last year. Okay, I think for this year, I'm not asking much. I'm just hoping that half of this outflow, right, return to Malaysia, then I think our market will be horsey. We may see the index to retest the 1,008 again. All right, but having said that, right, looking at the retail side, the retail portion, there's still a lot needs to be done for the retail portion. I think year to date, you're seeing a net outflow of about 2 billion ringgit. I think this needs a strong catalyst for the retailers to participate with vengeance on the local boss again. All right, next, please. All right, talking about foreign fund flows and also foreign shareholding, still steady at 19.1% for the foreign shareholding on the local boss. So nothing to shout about here. I think moving forward, if what I say comes true, half of what outflow came back to Malaysia, I think we should see the shareholding surpass the maybe touch the 20-25% again, hopefully. Next, please. All right, retail participation. I think most of the retailers are still being sidelined at the moment on the local bourse. As you can see that the retail participation remain really lackluster at around 15%, 14.9% as at February this year. So to me, I think this particular segment still needs a lot of attention before we see, a more intense retail participation. All right, I think certainly clear catalyst or a regain in confidence, amongst the retail investors. Right. Next, please. Okay, very fast conclusion. Okay, this is just a overview on the performance of Asian stock market. I think for Southeast Asia, I think Malaysia, okay lah. I think 1.1% after what happened over the last few days. But have a look at Indonesia. Indonesia is down by almost 40.5%. I think, as we all know, over the past few weeks, I think the Indonesian market has been besieged by sellers, I think due to the warning by S&P, on the investability of their stock market with regards to shareholding. Okay, so I think they need to rectify this very fast, right? As for the rest of Asia, I think although Hong Kong is down by 4.2% at the moment, this can be easily overturned. All right, I think Hong Kong will, all right, be in a positive situation as we move along over the next couple of months. All right, next, please. All right, to conclude, right, I think without a doubt, I think market performance will still largely depends on the duration of the US-Iran war. All right, and of course, the impact on crude oil prices. All right, despite Trump's confidence, I think he came out over the last few days saying that it'll be complete soon. I like to defer. I mean, don't quite believe him, as we believe this will be a protracted war. And if you see what Iran has done, with regards to the bombings of their neighboring Gulf countries, and also they have been ignoring Trump's so-called invitation to surrender. I believe this war is going to be a long one. It won't be like 1-2 week war. So okay. Then again, whether the US will put the brakes, remains to be seen. Like I said just now, as the war will cost an estimated $1 billion USD a day for the US, right? So again, if this war continues, Brent crude spikes above the 100 USD per barrel, you can see that US economy inflation will be in shambles again, right? So I mean, having said that, right, I'm not saying that you'll be like clear blue skies, over for Asian market as well, but I think Asian market for me would perform slightly better than the US, although it be a stop-start scenario, okay, over the next 1 or 2 months. I think for domestically, for Malaysia, I would say the strength of ringgit would remain as the main catalyst, all right, for the foreign fund managers. And I believe that recent gain shown by the ringgit against the USD is no fluke, all right. As we expect there to be more downside for the US dollar, all right. So for this year, I think the ringgit will trend between 380 to 390 range against the USD. All right, I think on the back of the US winning economy and also weakening labor market, and also lack of interest on US denominated assets. Right. Okay. Before I end, right, I have tweaked our FBM KSI target for this year slightly lower to 1,008 lah. I think we have 1,810 before. Okay. I think this is due to the overhanging uncertainty. So I just skewed a bit our expectations lower. Hence, this 1,008 would be our target for this year. Right. Next, please. I think that's all for now from me. Is it? Yep. That's all from me. Let me invite Pak Leng back and his update on the sectors. Hi, Pak Leng. All yours.
Hi, Kenny. Thank you. Okay, we'll begin on the sectors. We'll start with, next please. We'll start with auto sector. We are neutral on the auto sector. We project a total industry volume of 750,000 units in 2026. And the MAA reported January sales of 64,000, which is 27% higher year on year due to introduction of new model. But there are no upsides on the auto stocks. Therefore, we are neutral. On the banking, we continue to like banks given the solid fundamentals, which is very consistent dividend yields and earnings growth. The recent quarter results showing that they were broadly in line and within market expectations. 2026 earnings are expected to remain resilient, with loans growth projected at around 5%, supported by a stable OPR of 2.75% and a steady net interest margin of 2.1%. We like MBank, CIMB, Maybank, and RHB for their attractive dividend yields. Over to construction sector, we maintain overweight. The rollout of major infrastructure projects has been slower than expected. But the outlook for the sector in 2026 remains intact, and a strong potential job wins in the public and private sectors. Despite the MRT3 delay, the Ministry of Transport remains focused on ensuring the line is launched and completed safely. And other key projects to be rolled out in the near term, such as Penang LRT, Trans Borneo in the second half of this year, and the Subang Airport redevelopment, Johor E-Art, our topics, Gamuda, Sawmil Construction, Kejaya Prospect, Kim Lun, and Intabina. Next. Okay, on the consumer sector, we are overweight. It's driven by easing production costs and stronger ringgit against the US dollar, which makes imports cheaper. The resilient demand on the consumer products, essential consumer products, also a 15 billion cash allocation programs like the STR and SARA, and the rising tourism-related spending in anticipation of Visit Malaysia year 2026. Recent earnings have improved, and the margin, as well as the margin across the sector. We favor 99 Speedmart, Mr. DIY, FNN, and QL Resources. On the glove sector, we are neutral. They are, although improving, the pace of recovery is slower than what we expected. Despite, and also they no longer have a premium level of valuation. Malaysia glove makers continue to face oversupply and also stiff competition from China. And the stronger ringgit against the USD may pose a setback, but this will be mitigated by the lower material cost. We foresee improve in the outlook at the end of this year. On healthcare sector, the sector is supported by two main catalysts, Visit Malaysia year 2026 and also Malaysia Year of Medical Tourism 2026. Actually, there's a target of 12 billion industry revenue by 2030 and a 2026 this year is a critical launchpad year, and hospitals are shifting away from general care towards specialized high-margin centers of excellence. For healthcare provider, we like IHH for its potential upside, while pharmaceuticals, we like D Pharma. Next. Okay, oil and gas sector, we upgraded to overweight as currently it positioned as a primary defensive hedge and stabilizer in the middle of a Middle East conflict, because Brent crude oil has spiked above $100 per barrel, with a potential to touch $150 per barrel if the Strait of Hormuz continue to be restricted, which carry 20% of the global oil shipments. Yeah, but we believe companies with high operating leverage to crude oil prices will be benefit, and we recommend Hibiscus, Dialog, and Yinsen. On the plantation sector, we also upgrade to overweight as CPO futures rose to above 4,500 per ton, and we expect CPO price to range between 4,002 to 4,005 per ton in second quarter, given the higher commodity prices. Therefore, I think it will stay still high, and I think it will not fall to less than 4,002, and this will benefit upstream players such as IOI, Sign SDG, and KLK. We also like companies with good dividend, namely Taan. Okay, on the power utilities and renewable energy sector, we are overweight. Okay, a rapid expansion in the data center developments is supporting the electricity demand, and the government's plan to raise renewable energy capacity to 70% by 2050 from 25% currently, provides an additional long-term growth driver for the sector. As you see, in the past few months, we see quite a number of contracts from Tenaga for the solar panel companies. Also, the data center demand is expected to reach 12.9 gigawatt by 2030. We favor the sector for its earnings resilience and dividend yields, approximately 3 to 5%. TNB is expected to allocate 3 to 3.5 capex in this year, for the power grid. Our sector top picks are Tenaga, YTL Power, Malakoff, Samaiden, and SolarVest. Next. Okay, the property sector, we are neutral. The sector has moved beyond its long-standing overhang issues and is entering a phase of a structural realignment. And the market focus has shifted from a broad residential volume growth towards higher value segments such as industrial assets, data centers, and transit-oriented development (TODs). At present, most property developers have limited upside. However, we see Signprop, given its diversified earnings base and also attractive valuation. We also like Marsing for its flexibility, and UEM Sunrise, which is towards a lifestyle-centric branding strategy. The REIT sector, the outlook for REIT is mildly positive, supported by Visit Malaysia year 2026, and the growth in the data center. We will provide some growth in the industry REIT. On the flip side, Malaysian REIT is also navigating a period of a policy of uncertainty. The sector is dragged by its unresolved 10% withholding tax status, which has expired end of last year. And the Ministry of Finance has not confirmed any thing. Therefore, investors which get dividend from the REIT will be faced with high tax rates, up to 30% for individuals and 20% for companies. On the technology sector, we are overweight. The global AI spending is forecast to exceed $2.5 trillion this year, up from 1.5 trillion last year. And Malaysia's strategy for the tech sector in 2026 is shifted from broad digitalization to a highly focused AI nation 2030 and a semiconductor hub mandate. Semicon players, especially those with expanding wafer fabrication capacity and advanced packaging capabilities, are poised to outperform, and also the AI demand. Also, the outsourced semicon assembly and test industry will remain one of the most beneficiaries on the AI upcycle. Top picks are Inari, KGB, Frontcan, Northeast, and ITMax. The telco sector, we are neutral. Recently, the Celcom, Digi, and Maxis have completed their transaction to acquire the MOF DNB, which both players paying at 327.9 million each. Hence, we expect them to accelerate the 5G enterprise solution soon. On the downside, this acquisition may have impact on the core net profit for 2026 by 6 to 7%. The data center has become the most powerful structural analyst for the telco in 2026, and investment from global tech giant are driving demand for high-speed fiber connectivity and international submarine cable capacity. We are neutral in the sector because valuations are quite high, but we see potential upsides in Celcom, Digi, and TM. Okay, that's all for the sector, and I'll pass on to Crystal for the stock picks.
Sure. Is this okay? Thank you, Pak Leng. Okay, so hi everyone. Hope you are not zoning out because it's time for stock pick. So I'll start off with our local picks, followed by the foreign stocks later. So any of you, if you have any question, just comment in the comment box and we'll answer them right after the stock pick session. Okay. So without further ado, let me start off with our first stock pick, the blue chips. So we remain our M-Bank stock picks due to its strong performance and also strong upside. So M-Bank has delivered 9-month FY26 net profit of 1.58 billion within our expectations, and this is supported by a 6% growth in the net interest income, driven by stronger loan growth and improved funding cost management. So looking ahead, we are expecting net profit for FY25 to be at 2.12 billion, and with dividend payout expected to increase to about 53% in FY26 from previously 50% in FY25. So this will translate about a dividend yield of 5.2%. Thus, with that, our target price for M-Bank is at 7.54 ringgit, showing an upside of 16.5%. Next, we have the bank stock as well, CIMB. So CIMB reported FY25 core net profit of 7.86 billion, which is a 2% increase year on year. This is supported by the write-backs on the non-financing assets and the stable operating income. So the management continues to target the ROE of 11 to 11.5% while strategically reallocating the capital from Thailand and Indonesia back to Malaysia, where they see more potential of return from Malaysia. So the stock offered attractive dividend as well. slightly higher than mBank, approximately 6.2%. Hence, with that, target price is at 8 ringgit and 45 cent, upside potential of 7.6%. Follow up, we have Gamuda. So Gamuda also remained as our stock pick this quarter, although the share price has dropped but now seems to stabilize. So we believe with its strong fundamental and the share price likely to return anytime soon. So a bit of the results. So the first half, FY26, the net profit growth by 5% year on year. This is driven by the strong domestic construction activity, and its order book currently stands at 45.9 billion with a target to reach 50 billion by end of 2026. So this shows the strong earnings visibility for Gamuda. So the pipeline include water infrastructure, data center, railways, highways, renewable energy, and also transmission. Therefore, target price is at 5 ringgit and 30 cent, given based on a 22 times PE of calendar year 26 PER. Moving on, we have KLK. So the palm oil prices are expected to average around 4,000 to 4,400 per metric ton, while the productivity improvement through the mechanization and better agronomic practices are expected to support higher yields. So in addition to its plantation business, KLK also has ongoing property developments, including the Coyfield Retail Park and industrial projects in Kulai and Ijuk. Hence, the target price we give is about 24 ringgit based on a PBB of 1.7 times. And the last one for the blue chip, we have Tenaga Nasional, also remain as our stock pick. So Tenaga FY25 core net profit of 4.77 billion has exceeded our expectation about 6%, and this is due to the electricity demand continues to grow, particularly from the commercial segment linked to data center developments. And with that, we give a target price of 17 ringgit. And now move on to the small mid cap. Firstly, we have CBH. So CBHB has a tender book of approximately 730 million, largely consisting of data center, mechanical and electrical contracts. So its unbilled order book is strong with 591.9 million, which provide earnings visibility for the next 2 years, while management is targeting around 600 million in order book replenishment for FY26. And with that, we have a buy with a target price of 64 cents, which shows a 22% upside. Next on Intabina. So the company has secured 800 over million worth of new contracts in 2025, bringing its outstanding order book to approximately 1.7 billion, providing earnings visibility for the next 2 to 3 years. And the group has also ventured into their lift and escalator solutions, creating recurring maintenance income following project completion. And yep, with that, target price is 99 cents, showing a 148% upside. Follow up, we have Kerjaya Prospect. So Kerjaya Prospect also have a strong outstanding order book, about 4.4 billion, and recently secured new construction contract worth of 700 million year to date. So management is targeting 2 billion in new job wins for FY26, providing strong earnings visibility supported by its strong construction execution track record. Therefore, target price is set at 3 ringgit and 46 cents, which is about 40% upside. Next, we have Leng. So this is a medical devices distributor, which now they have an order book of 216.7 million, with more than 60% expected to be recognized in FY26. So providing strong near-term earnings visibility for Leng. So the company is also expanding into the Indonesia market through the PT Pyramid and plans to establish new branches there across Sumatra, Surabaya, and also Kalimantan by 2027, which would gradually contribute to revenue growth moving forward. And the target price is at 1 ringgit and 20 cents, showing a 47% upside. Following with that, we have Powerwell, last for the small mid cap. So Powerwell recently secured a 68.4 million data center project in Selangor and is also exploring renewable energy opportunities in Bangladesh. So in addition, the group plans to expand into the East Malaysia through the acquisition of the Tenaga Canary of 49% stake. So with that, the core net profit is projected to reach about 35 million for FY27. Therefore, target price at 90 cents, showing a 43% upside. And that sums up for our local stock picks. Now moving on to our Hong Kong dim sum. So the first one we have Baidu. Baidu continues to strengthen its position in China's leading AI platform through the AI cloud computing and also auto driving technologies. So its Apollo Go platform has resumed fully driverless operation in Dubai and Abu Dhabi, demonstrating the company's ability to scale auto mobility internationally. At the same time, Baidu is also launching their new AI cloud solutions support their enterprise adoption, positioning itself to benefit from the rapid growth of AI. So the target price is 173.54, showing 41% upside. Next on the banks. So Bank of China continues to modernize its banking ecosystem through the integration of generative AI and the digital financial services, improving both operational efficiency and customer engagement. As one of the China's largest financial institutions, the bank benefits from the strong deposit base, stable lending activity, and consistent dividend distribution. So the target price is 5 ringgit and 40 cents, showing 20% upside. Next, we have Geely Automobile. So Geely Automobile continues to strengthen its position within the global electrical vehicle supply chain. And recently, they have become the top-selling car maker in the first 2 months of 2026. So the company also currently collaborating with the Mercedes-Benz to develop next-gen EV platforms using Geely's GA 4.0 architecture. This reinforcing its technology capabilities in the EV developments. So with that, target price set at 25 and 17. Moving on JD Logistics. So JD Logistics is expanding global logistic network, and currently it has a partnership with the DHL Group, allows the European brands to access Chinese and European markets, while the launch of the Joy Express delivery service in the Europe has strengthened its international fulfillment capabilities. And with a 23% upside potential, the target price is at 16 ringgit and 87 cents. Okay, following with that, we have the last for the Hong Kong, which is Tencent. So Tencent remains one of the China's most dominant digital platform across those social media, gaming, fintech, and cloud services. So the key catalyst for the upcoming rollout, which is the WeChat AI agent, which designed to automate the services across millions of mini programs within the WeChat ecosystem. This has potentially unlocking their new monetization opportunities across its platform. So with that, there is a 36% upside and target price at 755.42. Now we have the US stock picks. So we have this Applied Materials with an upside potential of 22%, target price at 413.36. So the management expects over 20% growth in its semiconductor equipment segment in this 2026, supported by the strong demand from foundry, drum, and also the advanced packaging technologies driven by the AI infrastructure investments. So the customer visibility for Applied Materials extends to 2 years and beyond. And we have Exxon Enterprise. So Exxon is trading around 559.41, target price at 740.5. So the company continues to demonstrating strong customer stickiness with net revenue retention of over 100%. So this is supported by the growing adoption of the body cameras and law enforcement technology solutions globally. And we have General Dynamics. So General Dynamics continues to benefit from the rising global defense spending as the government invests in advanced military capabilities. And also the company recently secured major defense contracts, including the US Navy contract related to the Trident II missile control system and a cybersecurity modernization contract. This has strengthened their long-term defense revenue pipeline. With that, target price of $397, 10% upside. And next, we have Heiko Corporation. So Heiko continues strengthening its position in the aerospace component with acquisition and operation expansion. So the acquisition of the Ethos Energy's accessories and the components has enhanced its capabilities in the aircraft engine repair and maintenance, allowing the company to capture increasing demand in the global aviation service industry. Target price of 369.89, which imply a 19% upside potential. Last but not least, we have the Leng Research. So Leng Research remains a key beneficiary of the global semiconductor investment cycle driven by the AI and high-performance computing demand. So the company recently entered a multi-year partnership with CEA Leti, and this is to advance their next generation semiconductor technologies, while the demand visibility for semiconductor equipment is expanding towards 2027 due to the global AI chips investment. Okay, so the target price is showing a 31% upside, which is 276.42. And yep, that's all from me. I hope this session gives you a clearer view of what to expect in this quarter and where the opportunities lie. So with that, let me bring back Kenny and Park Lei because it's time for the Q&A. So feel free to ask any question if you have any, and we will answer them shortly. Thank you, everyone.
Okay. Any questions or not? I think Crystal, you're going to be the star today. I think a lot of questions on company specific.
Let me go through one by one. Okay. Hi James. Hi Dylan. Hi John. Hi KSKS. Hi G-Wei Core. Okay, let me start off with the first one. I think asking on. Hi KS. Okay, let me start off with the question from Dylan asking on LBS. Okay, wait a moment. Okay, let me show my screen first. Okay. So LBS. Okay. So looking at the chart, we can see that LBS Bina has experienced quite a strong downtrends during 2018 and have a sideways movement, and we see a strong recovery starting 2023 and a pullback 2024. So looking in the near term, we can see that LBS Bina actually is trading in a sideways movement, trading between 37 to 48 cents. Excuse me. So we can see that recently we have a bullish crossover after it break out from a near-term rectangular consolidation here. After it break out from rectangle consolidation, we can see quite a strong uptrend here. And currently it's actually testing its immediate resistance at 48 cents. These 2 days, we can see a long white candlestick yesterday. Today is closing the dodgy candle. So let's see there is a potential of breakout tomorrow, which seems likely after it breakout today during the intraday high at around 49 cents. So if it confirms a breakout tomorrow or the following week, which means the LBS Bina is likely to change its trend to a potential upside continuation after after a pullback since 2024 till 2025 April. So a breakout will confirm a trend reversal, and the next resistance to see for LBS Bina is around here, this level, 54.5 cents. And the support level to see for LBS, the nearest will be at around this level, 45, followed by probably this level, 41.5 cents. The outlook, near-term outlook, remains quite bullish given the EMA support bullish, widening, and also the stock jumping far away from the EMA 20-day EMA support level. Okay, that's a quick one for LBS.
Yeah, for fundamental, right? For LBS, consensus target price is 65 cents. Okay.
65 cents is about this level, 65. Ooh, long way to go. So it's quite bullish. Analyst is given quite a high upside potential. So let's see if it can confirm a breakout tomorrow or next week. Upside potential. So let's see if it can confirm a breakout tomorrow or next week. Upside potential. So let's see if it can confirm a breakout. I think Kenny has a echo behind. Okay, let me continue with the questions. Okay, from KS asking circle, should be, is it asking circle? Okay. Okay, let's see. So given the chart pattern, we can see that circle is actually newly listed, if not mistaken. It's around June last year. So we can see in the chart, it spiked up after its listing and have quite a strong pullback after a profit-taking session. So you can see that the support level is actually set at 64.13 cents, but it breaks out slightly below to 49, around 49 level. After that, it rebounded, and we can see quite a firm and solid rebound starting 25th February. So looking at the rebound, we believe that the strong support, the higher support set will be at 90 cents for circle. And looking the near term wise, it is likely that it will continue its rebound and continue the uptrend. So the next resistance you can set is at about 160. If you need a nearer one, will be around 139 or about 140 US dollar. So if it rebound, if it pullbacks, which we see at a healthy pullback given it's a consecutive green candlestick. So a pullback and staying strong above its key support at $90, it seems to be healthy. If it breaks below this 90 key support, then we might see a further correction and probably trending in a sideways movement within $49 to $90. Okay, that's for circle. Okay, let me continue with the questions. John Liu asking on American Airlines, if the price dropped to $9 to $10 worth to buy. Okay, let me have a look at the chart. Oh, $9 to $10. $9 to $10 is about 10.
Mind you, airline is very sensitive to oil price. Okay.
Yeah. Okay. So we can see that currently the stock is trading at around 11 ringgit and 4 cent. So you're asking if the stock dropped to below 9 to 10 9 ringgit, 9 to $10, is it worth to buy? Well, looking at the technical wise, we can see that after it break below its key support at around $11, the next support is at here. The nearest one is about $10.95. So if it breaks below this support, then likely it will probably next support at about, the longer one will be at around 9 ringgit. So it will be quite volatile, as Pat Ling mentioned, is due to the oil prices, crude oil prices. So it actually depends on your risk appetite. If you are a risk taker, 9 to 10 ringgit, actually looking at the long-term chart, is actually a good entry level. But do be alert, as the stock actually in quite a strong downtrend during due to the stock oil prices. So it will be risky if the uncertainties remains for these airlines, So this level could be a good entry level, but also be careful if it drops below its key support at around $8.50, then you probably should set a risk stop loss level. Okay, so that's for airline. And next questions on, hi Jovin, miss you too. And next question we have from Gwei Core, asking on Oracle. Okay, Oracle. Oh, okay. So Oracle experienced quite a strong downtrend since last year around September till this year. So actually, looking in the previous historical, is actually in a long-term uptrend, but since last year we have a strong pullback, strong downtrend. As you can see, I've drawn a lot of lines. So for Oracle, long-term, near-term wise, we can see actually currently is actually consolidating within a range of $137 to $178. So for Oracle, recently it has break out from a pennant pattern. So a breakout likely to give Oracle a short-term uptrend. So if it's possible to break above its immediate resistance at 178, then likely it will change the trend movement and potentially going back to its long-term uptrend. The uptrend could likely to confirm at around $194. So the first resistance to test will be at 178, second will be 194. Break above 194 will confirm the trend reversal and potentially uptrend continuation for Oracle. So the support level to see will be at around 154 followed by 137. A break below 137 will indicate a continuation of the downside. Okay, that's for Oracle. Next up, we have from Dylan. Again, from asking about Intel. So Intel, wait. Here. Okay, so for Intel, oops. So you can see actually Intel has experienced quite a strong downtrend here during 2024 January till August, and since then it has a consolidation here. It's here, consolidation for a few months, and it break out during September and continue its recovery. So you see that this is a recovery here. U-shape recovery. So looking at the near term, if it break out, decisive breakout from this level, we might see a continuation of its uptrend after a strong rebound. So this is a U shape, and this we treat it as a bullish cup and handle. This will be the handle if it rebound from its handle pattern. So this we take this as a handle. Okay. So we can see that it holds strong above its support at $42. So a decisive breakout will confirm the trend reversal and form a solid cup and handle pattern and continue its uptrend movement for Intel after a strong sideways, a long big sideways movement from 17 to 62. Okay, the setup wise is quite bullish given the EMA lines remain 20-day EMA remain above the 50-day EMA. Also posted a few green candlesticks and holding strong above its key support level at 42 cents. So if it didn't manage to hold, then the second support will be at around this level, $35. Okay, that's for Intel.
Okay, Sharon Isabel Wong asked if there's no good news on the REIT. Okay, would there be a spike in a massive sell-off? Yes, the sell-off it's already done. We see some. It was done somewhere in January and February. If you look at the chart of the REITs, the share price has went down by a few percent. Okay, on the DNB and the telco thing, right? It will not impact the revenue, but in fact, if they accelerate the 5G, it will improve the revenue. But what will the impact on the DNB is? They will have it will be a cost to the telcos. Therefore, the profit margin might be slightly affected by about 6 to 7%. Okay.
Okay. Let me see. No worries, Cass. From SLM Way, what is the prospect and fundamental for CloudPoint, SolarVest, and MN Holding based on latest quarter? We didn't really study very specific on each of the stocks, but what I can recall is that there has been in a strong fundamental given their pipeline is actually quite strong. Their outstanding order book is high. So what I can say is that, let me show you the chart. CloudPoint. So CloudPoint has experienced quite a huge pullback after a spike during 2025 February. So after it break out from a few support level, we can see that CloudPoint is actually trading near its listing price. Currently, the recent low is at about 46 cents, and we see a slight rebound here, just a mild rebound. So technical wise, it's quite bearish as there is no confirm of trend reversal yet, although there is a slight close above the 20-day EMA resistance line. So for CloudPoint, the lowest level it went previously is at 41 cents. So if you want to buy this stock, probably you should set a stop loss, as this, looking at the technical wise historical, this will be a good entry level as it is at their all-time low for CloudPoint. And if the stock rebounded and possibly break above the key support at 57.5 cents, then we might see a potential trend reversal for CloudPoint to continue a long, huge sideways movement between 57 to 84 cents. Okay, near term wise, still probably trading between 46 to 57. Okay, let me take a few more questions as we end at 9:15. Gway Core. Oh, let me walk you through a quick one on SolarVest and also the MN Holding. So SolarVest, actually the solar sector has a few counters also experienced a similar pattern after the new policy came out. So we can see that SolarVest currently holding above its key support at around 1 ringgit and 80 cent. So which means this might be a good entry level as well before a spike from its long-term uptrend here. So for SolarVest, if it holds strong above this key support level, then we might see a near-term consolidation phase between 1 ringgit and 86, followed by 2 ringgit and 50 cent. So probably in a sideways movement. And for MN Holding, I just issued a technical report today. So looking at MN Holding, we can see that after it's currently trading in a sideways movement as well, trading between 141 to 1 ringgit 41 to 1 ringgit 82. So looking in the near term, MN Holding is likely to move in a sideways and likely to test this immediate resistance at 1 ringgit 73. Possibly will test a few times to break out. So for short-term traders, it will be an opportunity for the short-term buying during near the support level. Okay, and let me see. Let me take the questions from WK Wong asking on AMD, Meta, Palantir. AMD. Okay, AMD currently moving in a higher sideways after a strong rebound. So we can see that after it tested its new all-time high at $267, we can see it tested 2 times, didn't break above, so it's probably trading in a sideways now. So for the AMD, we believe the near-term outlook would be a sideways as well, trading in the lower end of its uptrend within 187 to 220. As you can see, it's currently trading quite in a in a kind of downward pattern here. So a break above the resistance line would show a potential continuation uptrend for AMD. As for the second Meta platform, so Meta, we can see a huge gap up during January and it pulled back since then. So for Meta platform, we see that near term would likely hold strong above its key support at around 628 and probably in a sideways as well, looking at the chart pattern and the trend. So given that it is trading in a sideways, a breakout from a rectangle pattern would bring a potential short-term uptrend for the Meta platform. Yep, and the support level set will be at 628, followed by 596 level. And this one, okay. As for Palantir, we can see that after it tested its new all-time high at around $207, we see a huge pullback and holding strong after it break below its key support at 151 level and meet another support at 127. We see a rebound here, forming a U-shaped recovery and a pullback afterwards. So if it then holds strong above here, 140, a rebound at this level will indicate a potential of uptrend in the near term and likely to test the all-time high at 207, probably in a medium-term length. Okay. I think that will be all for tonight since it's 9:15.
Okay.
Yeah.
So we shall
Okay.
good night. I think
Wish
sorry
you a
to
very
stop the camera. Okay, so good night and thanks for joining us tonight. See you next time.
Yeah.
Thank you, everyone. Thank you for your time. See you next time. Bye-bye.
Bye bye.